Hi and Assalamualaikum. My name is Nurul Atirah binti Amaran from A4AC1105M. So today I will explaining about question 1 from group assignment December 17. So we shall look at the question first. On 1st July 2015, Evergreen Berhad acquired a building at the cost of Rm 2 million. The economic useful life of the building was estimated to be 50 years. Evergreen Berhad had been using the building as its staff training center. The fair value of the building on 1st July 2016 was Rm 2,058,000. It is the policy of the company to measure its property, plant and equipment using revaluation model and investment property using fair value model. Accounting year end on 30th June. For question A, it is required us to discuss the accounting treatment of the building for the year ended 30th June 2016 and 30th June 2017. For question B, we are need to assuming on 1st July 2016, Evergreen Berhad had decided to lease out the building to the tenant under operating lease. Fair value of the building on 30th June was Rm 2,158,000. So we need to discuss the accounting treatment of the building for the year ended 30th June 2017. Okay, next we shall look at the answer for the question 1A, accounting treatment for 30th June 2016. On 1st July 2016, Evergreen Berhad acquired a building at cost of Rm 2 million. The depreciation charge for the building is amounted Rm 40,000, which is must be expensed off in the SOPL as at 30th June 2016. The carrying amount of the building is Rm 1,960,000. So for the accounting treatment for 30th June 2017, there is a surplus or revaluation amounting Rm 98,000 will be credited at the asset revaluation reserve. Since the company adopt revaluation model, the fair value of Rm 2,558,000 will be carrying amount of the building as at 1st June 2016. The depreciation amount is Rm 42,000 and it will be expensed off to the SOPL. Hence, the carrying amount is Rm 2,016,000 as at 30th June 2016. So, we shall look at the question 1B. Question 1B, the accounting treatment is on 1st July 2017, date of transfer from the MFRS 116 PPE to MFRS 140 investment property because there is a change in use from the owner occupied to rent out under operating lease. The carrying value is Rm 1,960,000 and the accumulated depreciation is Rm 40,000 will be eliminated. The fair value of the building is Rm 2,058,000 and there will be a surplus on evaluation amounting 98,000 will be recognized and expensed off in the asset revaluation reserve. Since the IP adopts fair value model, there is no depreciation provided. Thus, there is a gain on revaluation of Rm 100,000 as at 30th June 2017. So here is the journal entry for the above accounting treatment. On 1st July, we will be debited investment property, debit accumulated depreciation and credit property, plant and equipment. On 30th June 2017, we will be debited investment property, and credit gain on fair value.
Hi, my name is Siti Nur'amirah. For question 2, Vista Berhad bought an asset at cost of Rm75,000 on 1 July 2016. On 30 June 2017, similar asset had been actively traded in market at 85,000. The cost to sell is Rm2,500. Requirement A, assuming the asset is catered for its needs. This is under MFRS 141 Agriculture. Explain the appropriate accounting treatment of the asset for the year ended 30 June 2017. Prepare the journal entries to record the above transaction. Required B, assuming the asset is equipment used in research activity which has an estimated useful life of 5 years, cost model is adopted. This requirement under MFRS 116 property, plant and equipment. Explain the appropriate accounting treatment of the asset for the year ended 30 June 2017. Prepare the journal entries to record the above transaction. For timeline, catered for its mates, 1 July 2016, the company bought at cost at Rm75,000. After 1 year, the company on 30 June 2017 traded the cattle in market for Rm85,000 and cost to sell is Rm2,500. Explain the appropriate accounting treatment of the asset for the year ended 30 June 2017. The cattle is recognized as a biological asset on 1 July under MFRS 141 Agriculture as a living animal used in agriculture activity. It is initially measured at initial cost of Rm75,000. On 30 June, it is measured at fair value cost less point of sale cost of Rm82,500. The increase in fair value of 77,500 is credited to SOPL. Gain change in fair value. The carrying amount of the set of the cattle in the SOPI is shown at Rm82,500. Under fair value model, the cattle is not depreciated and not tested for impairment. Timeline for question B. Timeline for question B, equipment used in research activity. For the journal entries, for above transaction, debit biological asset Rm75,000 and credit bank 75,000. Debit biological assets and credit SOPL gain change in fair value. Timeline for question B, equipment used in research activity. On 1 July 2016, equipment bought at cost Rm75,000 and useful life of 5 years. This equipment use cost model. On 30 June 2017, the equipment traded in market at 85,000 and cost to sell is Rm2,500. For answering appropriate accounting treatment of the asset for the year ended 30 June 2017. On 1 July 2016, the asset is initially recognized as item of PPE under MFRS 116 Property Plant Equipment, as it is a tangible item used in research activity and is expected to be used in 5 years. More than a year, the equipment is initially measured at its cost of Rn 75,000. Since the company used cost model, the carrying amount of the equipment will be measured at cost less accumulated depreciation at Rn 60,000. The depreciation of PPE is Rn 50,000 will be recognized as research cost as the equipment is used for research activity in software as expenses. For the journal entries, debit depreciation Rm 50,000 and credit accumulated depreciation Rm 50,000. Debit SOPL and research cost, credit depreciation Rm 50,000.
Assalamualaikum, I'm Nur Ayu Syuhada. So we'll continue to the next question, which is question 3. Okay, so Present Berhad acquired an asset on 1st July 2016 for 800,000. The useful life of the asset is estimated to be 50 years. Fair value of the asset given by an independent valuer on 30th June 2017 was Rm 980,000. For the subsequent measurement, the company adopts the following model. So IP uses a fair value model, PPE evaluation, IA cost model. Okay, so these are the requirements that we need to do. Okay, so next. This is the timeline for the question. Okay, so on 1st July, they acquired an asset of Rm 800,000 for estimated useful life 50 years, and the fair value as at 30th June 2017 was Rm 980,000. So the first requirement is to discuss the accounting treatment for the asset for the year ended 30th June 2017, assuming that the asset of building was rented out to Present Berhad's subsidiary company. So when they say that the asset or the building was rented out, which means that it is an investment property. Okay, so the accounting treatment is on 1st January 2016, the building was recognized as an investment property in accordance with MFRS 140, as it was used to earn rental. The initial cost of the building was Rm 800,000. So as at 30th June 2017, under the fair value model, the fair value of the building amounting to Rm 980,000 is compared with its carrying value of Rm 800,000. The gain in fair value of 180,000 is recognized as part of the other income in the software. So how do we get 180,000? We have fair value of 980,000 minus with the carrying value of 800,000, so we get the gain in fair value of 180,000. Okay, so since the company uses the fair value model, so no depreciation and impairment tests are to be provided for the building. The investment property is shown in SOFP at its fair value of Rm 980,000. So this amount will be shown under non-current asset. The next question is discuss the accounting treatment of the asset for the year ended 30th June 2017, assuming the asset was a building provided by Berhad as housing facility to its foreign workers. So the company uses the building as admin purpose to their workers. Okay, so the accounting treatment is on 1st July 2016, the building was recognized as PPE in accordance with MFRS 116 as it is a tangible item used in administrative purposes when the company used as housing facility to its foreign workers, and it is expected to be used for 50 years, which is more than 1 year, and the initial cost of the building was Rm 800,000. So as at 30th June 2017, an annual depreciation of Rm 16,000 is charged as an expense in SOPL. So how do we get the 16,000? So we need to take the initial cost of 800,000 divided by the estimated useful life of 50 years. So we get the depreciation. So under the revaluation model, the fair value of the building of Rm 980,000 is compared with its carrying value of 784,000. So we need to take the initial cost minus with the depreciation to get the carrying value of 784,000. The increase in carrying amount of Rm 196,000 is recognized as revaluation surplus and will be credited to asset revaluation reserve in SOCI and is shown as other comprehensive income in the SOPL. So, to calculate the increase in carrying amount, we need to take the fair value minus with the carrying value. So we'll get the increase because the fair value is much higher than the carrying value. Next is assuming the asset above was a license and on 30th June 2017 the recoverable amount was 700,000. Okay, so we need to calculate the impairment loss and prepare the journal entries on the impairment loss. Okay, so for the calculation, we need to take the initial cost minus with amortization expense to get the carrying amount, and we need to compare it with the recoverable amount, and then we will get the impairment loss. Okay, so initial cost as at 1st July 2016 was 800,000. Amortization expense is 16,000, which is 800,000 divided by 50 years. So 800,000 minus with 16,000 will get 784,000, the carrying amount. So we need to compare the carrying amount and recoverable amount, which we will get 84,000 of impairment loss. Okay, so for the journal entry on the impairment loss, we need to debit the impairment loss, SOPL impairment loss 84,000, and credit the accumulated impairment loss, which is 84,000. Okay, so that's all for question 3.
Assalamualaikum, my name is Muhammad Izzaddin. I want to explain about question 4. On 1 July 2016, the plant, property and equipment ledger of Clemson Berhad show the following balance. Plant at cost is 12 million ringgit and accumulated depreciation is 4,800 ringgit. It is the company policy to provide depreciation on plant at 10% per annum on yearly basis. The following information was made available during the year. On 1 October 2016, one of the plant components was replaced, but it was only to restore the plant to its previous condition. Replacement cost is 65,000 ringgit. On 30 June 2017, one of the major components of plan was replaced by Crimson Berhad, which put the plant in a better operating condition and extend its useful life. Replacement cost was 500,000. The oil component was purchased on 1 July 2013 at the cost of 350,000 ringgit. Explain the accounting treatment for transaction in A. On 1 October 2016, one of the plant components was replaced, but it was only to restore the plant to its previous condition. Replacement cost is 65,000 ringgit. The answer is the replacement cost does not meet recognition criteria in MFRS 116 because there is minor cost to restore the plant. The cost more like a maintenance cost, which is to make sure the component of the plant working usually. So, the replacement cost of 65,000 must be written off as expense in statement of profit or loss. This cost should not include in current asset in statement of financial position. Prepare journal entries to record transaction on B. On 30 June 2017, one of the major components of plant was replaced by entity which put the plant in a better operating condition and extend its useful life. Replacement cost was 500,000 ringgit. The oil component was purchased on 1 July 2030 at a cost of 350,000 ringgit. This transaction we can get now this transaction is made to the recognition of criteria in MFRS 116 because of the entity want to replace major components of plant and put the plant in a better operating condition and extend its useful life. This plan will give them or entity in future benefits. Plan at cost 12 million ringgit minus by accumulated depreciation 4,800,000 ringgit, and we can get 7,200,000 ringgit, which is carrying amount on 1 July 2016. After that, we must pass new components amount 500,000 ringgit and minus all components which is taken out from the account by entity amount 210,000 ringgit. How can I get 210,000 ringgit? The all components at cost amount 350,000 ringgit minus by 140,000 ringgit, and we can get 210,000 ringgit. So the carrying amount on 1 July 2017 is 7,490,000 ringgit. So the journal entry is debit plan, which is new components 500,000 and credit cash 500,000. Second journal entries to this transaction is debit accumulated depreciation 140,000 ringgit, debit sopel carrying amount of oil component 210,000 ringgit, and credit plant oil components 350 ringgit.
We will move to the question 5. For the first, let's look at the question. A property development company, Damai Berhad, had completed the development of 20 units of shop houses on 1st July 2015. Each unit cost at Rm 750,000. On 30th June 2017, the market value of each unit was Rm 1 million. The policy of the company is to measure its investment property using the fair value model and property, plant and equipment using revaluation model. The financial year ends on 30th June each year. So for the question A, assuming the 20th unit of shop houses for sale in the ordinary course of the business. On the 30th June 2017, there were 3 units remain unsold. So first, we need to identify the MFRS used. Next, we need to explain the accounting treatment of the unsold unit in accordance to the relevant MFRS. Okay, first, for the question A, it is a MFRS 102 inventory. And accounting treatment for question B is the unsold item will be recognized as an inventory under MFRS 102 based on the definition of the inventory as at 30th June 2017. The cost of inventory are RM 2,250,000 and the costs are lower than the next realizable value. So we need to take the cost. So the cost amounting RM 2,250,000 will be recognized in SOPL as at 30th June 2017. That's all from me. Thank you.
Question 5. A property development company, Damai Berhad, had completed the development of 20 units of shop houses on 1 July 2015. Each unit cost at 750 ringgit, 50,000 ringgit. On 30 June
Okay, first,
2017,
for the
the
question
market
is,
value of each unit
it
was
is a
1 million.
MFRS
The
102
policy of the
inventory.
company is
And
to
accounting
measure its
treatment for
investment
question B
property
is the unsold
using the fair value
item will
model
be recognized as
and
an inventory
property,
under
plant and
MFRS
equipment using the
102
valuation
based
model.
on the
The
definition
financial
of
year
the inventory as
ends
at
on
30th
30 June
June
each year.
2017. The cost of inventory
Assuming
are
that
RM
17 units of shop house are rented out and the other 3
2,250,000
units
and the costs are
are
lower than the
occupied by
next
the
realizable
Damai Berhad,
value. So we need to
each
take
unit
the cost.
could
So
be
the cost
sold
amounting RM
separately.
2,250,000
Explain the accounting treatment for the shop
will be
houses for the year
recognized in
ended
SOPL as
30 June
at 30th June
2017.
2017. That's all from me. Thank you.
Because of the shop houses can be leased and sold up separately, the member must accounted the shop house for separately. The 17 units of shop house that are rented out can be classified as investment property in MFRS 140, and the amount of initial cost is 12,750,000 ringgit. The balances of 3 units of shop houses that are occupied by entity shall be classified as owner-occupied property and also known as a PPE at cost 2,250,000 ringgit. No depreciation should be measured because investment property adopts fair value model. Any changes of gain or loss in fair value model should be recognized in statement of profit or loss. On the other hand, the carrying amount should be measured based on cost less accumulated depreciation and accumulated impairment losses because the company used revaluation model in valuing PPE. Okay, that's all for me. Thank you.